Coming up on Market to Market, the focus in Washington shifts from fiscal issues and gun control to immigration reform. Renewable fuels advocates prepare to use a few assault weapons of their own on big oil. And livestock markets rally on dwindling cattle supplies and friendly developments in Japan. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, February 1 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. A key government report Friday revealed the U.S. labor market improved modestly last month, but it appears to have expanded significantly late in 2012. According to the Labor Department, employers added 157,000 workers to their payrolls in January. Upward revisions of previous data also reflected nearly 450,000 new jobs in the final 2 months of 2012. Other developments this week, however, were less positive. The national unemployment rate ticked up 0.1 of a point in January to 7.9%, and the Commerce Department announced that U.S. gross domestic product, the broadest measure of the economy, shrank in the fourth quarter for the first time in 3.5 years. Nevertheless, the mostly positive jobs report was welcomed on Wall Street, and the Dow Jones Industrial Average settled above 14,000 Friday for the first time since October of 2007. An improving economic outlook enables the Obama administration to concentrate on other domestic priorities like gun control. This week, though, the president set his sights on immigration reform. Former competitors for the presidency, Senator John McCain and President Barack Obama, have spent much of the past 4 years butting heads on a series of domestic and international issues. This week, in a pair of separate public appearances, the two appeared to find common ground on immigration.
We have been too content for too long to allow individuals to mow our lawn, serve our food, clean our homes, and even watch our children, while not affording them any of the benefits that make our country so great. I think everyone agrees that it's not beneficial for our country to have these people here hidden in the shadows.
Speaking in the Latino-rich community of Las Vegas, the president echoed a sense of urgency on federal immigration reform.
It requires us to act. And I know that some issues will be harder to lift than others. Some debates will be more contentious. That's to be expected. But the reason I came here today is because of a challenge where the differences are dwindling, where a broad consensus is emerging, and where a call for action can now be heard coming from all across America.
The president's full-court press on an immigration overhaul has mobilized a series of advocacy groups, each hoping a comprehensive bill could meet a series of goals.
What we have been discussing is a moratorium on deportations. I mean, we're such in a big hole that we got to stop digging. And that's one of the things that we are asking is that there be a moratorium on any kind of deportations. If we're going to be working on this, let's get serious. I mean, that's a serious issue.
The biggest development on immigration this week came from outside the White House, as a bipartisan group of senators, including Republican Marco Rubio of Florida and Democrat Chuck Schumer of New York, unveiled a framework for comprehensive reforms.
Our framework contains 4 basic pillars. First, we create a tough but fair path to citizenship for illegal immigrants currently living in the United States that is contingent upon securing our borders. Second, we reform our legal immigration system to better recognize the importance of characteristics that will help build the American economy and strengthen American families. Third, we create an effective employment verification system that will prevent identity theft and end the hiring of future unauthorized workers. And lastly, we establish an improved process for admitting future workers to serve our nation's workforce needs while simultaneously protecting all workers.
The framework could have significant implications for rural America and immigrant workers drawn to low-wage jobs in the agricultural sector.
Well, it's a huge deal, and as my colleagues can note, the fact that there's not a comprehensive approach to immigration reform for all these many years has left many, many families in limbo for many years and in very uncertain economic conditions, and we're very, very concerned. They've been waiting a long time.
But a second-term push for immigration reform has a muddled track record in presidential history. President Ronald Reagan passed a massive immigration overhaul in 1986, but critics lamented the policy as amnesty years later.
For a few minutes of your time to discuss a matter of national importance, the reform of America's immigration system.
President George W. Bush used his diminished political capital for immigration reform in 2006, following a failed bid to overhaul Social Security.
Crowds have rallied in support of those in our country illegally.
Despite some bipartisan support, the Bush bid fell victim to Republican congressional leaders and outside groups concerned about border security. President Obama's immigration prospects will likely depend on the success of the budding senatorial Gang of Eight and its ability to draw support from both sides of the aisle.
For the first time in many years, Republicans and Democrats seem ready to tackle this problem together.
A federal appeals court ruled last week that the Environmental Protection Agency overestimated the amount of fuel that can be produced from grasses, wood, and other plants in an effort to promote the renewable fuels industry. Federal law requires that a small portion of cellulosic biofuels be mixed with gasoline each year. Despite annual EPA projections that the industry would produce the innovative biofuel, none of that production materialized. The court threw out the EPA estimates in response to a challenge filed by the oil industry. But the court also rejected the oil industry's arguments that EPA should have lowered production mandates for other renewable fuels. And so it goes in the ongoing battle between the renewable fuels industry and big oil. But at meetings this week in Iowa, ethanol proponents announced they're taking off the gloves. U.S. agriculture is still reeling from the worst drought in half a century. While farmers produced the 8th largest corn crop in history, the 2012 harvest was still well below expectations. And as prices soared to record levels last summer, livestock producers experienced shrinking profit margins.
The reality is that given where corn stocks are right now, we're going to face some significant volatility. And we've been telling this to livestock operators, is to shore up on your working capital, because ultimately we are going to be facing volatility, and you want to enjoy the good years when they're there, but be prepared for the bad years.
Nathan Kaufman, an economist with the Federal Reserve Bank of Kansas City, says corn prices could range from $4 to $8 per bushel this year. 2014, though, may be an entirely different story.
As corn prices stay low, in 2014, the February futures price might not be $5.50, and it might not incent farm operators to plant record acreage to corn. We typically say within agriculture, the best cure for high prices is high prices.
This would be welcome news for sectors relying on corn as their dominant feedstock. The renewable fuel industry also struggled in 2012 as the cost of its key ingredient soared. 2013 is starting dry, raising some concerns that another short crop will push corn prices even higher. At the Iowa Renewable Fuels Summit this week near Des Moines, industry insiders shared projections and goals for the future. Iowa is the nation's top producer of ethanol and biodiesel. The renewable energy industry claims 60,000 jobs are tied either directly or indirectly to its operations, and it contributes $5.5 billion to the Iowa economy annually. Nevertheless, proponents say there's still plenty of room for growth.
Buying it's voluntary. E15 or any higher blend is not mandatory, which some people seem to get wrong and perpetually push it out there for misinformation, but it's voluntary. So we have to convince the consumer to want to buy it. And when the consumer demand is there, that entices the retailer to want to offer it.
Tom Bias of Growth Energy says oil companies and others with vested interests are stoking the food versus fuel debate. Bias indicates he's using former U.S. General George Patton as an inspiration for biofuels in 2013.
You don't win a fight being on the defensive. And oil has pulled out, and their allies, all the stops against ethanol production because it's a threat to their vested interest. And if we don't push back, they get a free pass, and people start to believe it.
Part of the ethanol industry's plan includes noting a milestone for the petroleum industry.
The oldest oil subsidies go back to 1913. We're literally this year in 2013 celebrating a century of subsidies for big oil. And if you're not going to get rid of theirs, and that'd be fine with us, but if you're not going to, then we need to do something for these younger parts of our industry to help level the playing field, because right now they're swimming upstream. Whenever someone asks me about, well, why does ethanol or biodiesel need this and that, I'm like, why does oil after 100 years need it?
Monty Shaw leads the Iowa Renewable Fuels Association and has made his goal in 2013 to make sure the renewable fuel standard, the federal mandate to produce 36 billion gallons by 2022, stays in place.
Well, I think our biggest focus and biggest hurdle this year is the political battle over the future of the industry. The big oil is coming after us like gangbusters. They want to repeal the federal renewable fuel standard, and we really need that. So we need to keep the RFS to crack through that monopoly, to crack through that mandate, to level the playing field for subsidies. We're cheaper, we're cleaner, we're better. Ethanol and biodiesel will be fine. But right now, the federal policy is tilted decidedly in the favor of big oil.
Shaw says the RFS is his industry's way to gain access to pumps, giving consumers a choice.
In a way, that is why we're pushing so hard to get E15 out in front of consumers. It's only 5% more ethanol from your engine's perspective, but going from 10 to 15 is a 50% increase in market demand. We really feel that those higher ethanol blends can be what sucks in the corn and keeps the market firm on the years when we have good harvests. And then, hey, if we have another 2012, you can always take that blend back down to the E10 level.
I'd gladly compare our industry to oil. You want to compare us on the environment? We're a lot more environmentally friendly than oil. You want to compare us on price? We're the lowest cost fuel in the world. You want to compare us on what's best for our national security? There are no wars that have been fought over ethanol.
Next, the Market-to-Market Report.
A U.S. District Court judge sentenced the embattled founder of Peregrine Financial Group to 50 years in prison Thursday for stealing $215 million from investors. Prosecutors say 64-year-old Russ Wassendorf Sr. committed fraud every day for 20 years at his Cedar Falls, Iowa brokerage and victimized more than 13,000 customers. Fraudulent behavior aside, commodity trading is tricky enough, even when everyone plays by the rules. And this week, those with the intestinal fortitude to trade grain markets encountered mixed prices. For the week, March wheat lost 12 cents, while the nearby corn contract moved 15 cents higher. Soybeans continued their upward trend as the March contract posted a weekly gain of 33 cents. Nearby meal prices advanced by nearly $12 per ton. In the softs, cotton rallied again this week as the March contract gained nearly $2.50 per hundredweight. In the dairy market, March Class 3 milk gained 17 cents, while the deferred contract moved 6 cents higher. Over in livestock, April cattle posted a weekly gain of $1.42. Nearby feeders advanced by $1.25, but the April lean hog contract posted a weekly loss of 17 cents. In the financials, the euro gained 196 basis points against the dollar. Crude oil gained $1.89 per barrel. COMEX gold advanced by $11 per ounce, and the Goldman Sachs Commodity Index gained more than 15 points to settle at 679.25. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Oh, good to be back, Mike.
We talked earlier in the show about the contraction of GDP faced in the fourth quarter of 2012. With that in mind, what impact is that going to have on the Federal Reserve and the dollar as we roll through 2013?
Yeah, I think as you talked about in the open, what we have to do is we have to look at all these economic reports kind of in the total, and the sense that we're getting is, despite the GDP, is that we're still seeing this this small recovery starting to gain some momentum. Now, the GDP did kind of put a little bit of a wet blanket on that, but I think longer term, what it looks like the trends are indicating is we're going to see the dollar continuing to come down. I think it's going to continue to lose some ground to the euro, at least for a little while. If it does that, then you're going to see some of the key markets like the metals, energies, grains, and so on start to find this support. And we're already moving into some seasonal uptrends. We saw it this week, most notably in the beans and the crude oil and so on. commodities are starting to take off. I think a lot of it has to do with these small signs of growth and the idea that the U.S. dollar index is going to continue to sag a bit.
Just a general positivity in the markets about sort of the future of the economy.
Yeah, we've got the Dow going up over 14,000, as you pointed out, for the first time since October 2007. Really a landmark month and year. Because it was after that we saw the first signs of the economic meltdown that would be 2008. So, going back to that far, and now we're back to that point. I think it means a great deal for the market. I think it's really building some momentum, and the more confident we're starting to see in the investment markets, then I think that's going to spill over into the other sectors as well.
Well, let's talk the other sectors. Let's talk grain. Wheat this week, we saw a little bit of a pullback, about an 11-cent drop from last week. What's going on there?
Biggest thing in wheat is it really has no reason to rally. It's too early to be overly concerned, at least from the market's point of view, about the poor winter wheat crop that's most likely to come out of dormancy here in another month or so. Globally, we've got plenty of wheat stock, so it's not one of those situations like corn and beans where we're constantly talking about tight global fundamentals. It's just not going to happen, and it's probably not going to be for quite some time before we see wheat in that situation. So without any of those things happening, we saw wheat really crumble on Friday, despite some bullish news out there. It just doesn't have any friends right now. It just doesn't have anyone willing to step in and be a long-term buyer.
With that in mind, what sort of prices do you see us trading between here going forward?
Well, I still think we're going to try to rally these markets. I think we're going to stabilize in here. The Chicago March wheat keeps bumping its head up against the $8 mark. Can it get through there? Maybe at some point. It's going to have some help from corn. It's going to have some help from some of the other markets. U.S. dollar index coming down. We need to see exports start to pick up. So, keep a close eye on wheat as March Chicago, as it gets up close to that $8. The equivalent in Kansas City, Minneapolis has been struggling as well. Seasonally, this isn't a great time for wheat like it is the other grains. So it's going to, there are some problems lining up to keep pressure on wheat, but just enough support from the others could help pull it higher.
We could see a little bit of
a small rally at best.
All right. Well, let's look at corn. We talked about the weakening dollar. Is that having any impact on our corn exports? I know they've been dismal all winter.
Right.
How do they look from here?
Well, to me, I think we're going to start to see our export business start to pick up a little bit. I think some of the countries who have filled that gap that we just couldn't do because of tight supplies for the third year in a row, I think we're going to start to see some of that business. I think those countries have probably hit their limits at this point. So, the last couple of reports, the weekly inspections and the weekly shipment report that came out this week, we started to see an uptick in movement of U.S. corn. So I think this is something that's going to continue. Certainly a lower dollar isn't going to hurt. Maybe we'll start to see some sales pick up as well. We've had good demand in corn, and despite all this talk of poor demand, poor exports and all this, basis has remained quite strong nationally. The future spreads continue to show a bullish commercial outlook longer term through the spring. So the reason for that has to be that demand is still strong, and that there's this feeling that exports will start to pick up.
Now, as exports pick up and we see a little bit more of that demand reflected in the market, where do you think prices could go here on old crop?
March corn finally got through its resistance at 734, so now it looks like it could target 762. If we start to see a runaway in this market, maybe the peak up there could be about 790 in the March contracts of old crop. So I think there's going to be some opportunities. We're still in that time frame seasonally when both corn and beans post a pretty solid rally. So we've got some time, we've got some space in these markets for them to rally. So I think there's going to be some opportunities. Again, with a good strong basis, it's going to make for some good cash sales. So kind of keep a close eye on it, and as long as we're starting to build this momentum, then we start to get the news that exports are happening. I think it's going to give us a pretty decent rally in here.
Now, growing on that, looking at the seasonals and the potential increase in demand, would that make this a good time for livestock producers who have been buying hand to mouth to maybe step in? And
I think so. We get into this, I'm not going to call it spring yet. It'd be wishful thinking at best, with zero temperatures pretty much across the country. But as we get into this time of year, again, this is when commodities start to move higher. They start to feel a little bit better, and they start to rally a little bit. So those end users who don't have coverage on may want to look at getting it on, because if it comes down to where we're really starting to fight for bushels before before we start to see some early harvest in the south. I think that's what's really going to cap this thing off. It's really going to push this thing higher once we get past mid spring into early summer. That's when I think the market's really going to take off.
All right. Well, let's look at soybeans. So we've been having a nice rally in soybeans past couple of weeks, continued this week. Where do you see old crop beans headed? Well,
beans are the most bullish market we have fundamentally. Everything seems to hinge on day-to-day, week-to-week South American weather forecasts. As we come into this weekend, now they're saying there could be more rains in parts that don't need it in Brazil, and so this kind of helped kick things up a little bit early on Friday. We still have very strong exports going on from the United States, so it looks to me like we're going to be challenging that $15 mark here before too very long. I think we'll get through that relatively easily. We've bounced up against there a couple different times. 15.5, possibly up to 16, certainly looks like a reasonable target. There's just not much resistance in the bean market because global supplies are so tight. Now, a lot of this is going to depend on how quickly harvest occurs in South America, the logistics getting it to port. Once we see those beans actually starting to make it to port and get into the export market, that's going to slow our rally a bit. But seasonally, soybeans do tend to rally up through, say, mid-July, early August.
So it's looking positive for bean producers up through then.
It is, because again, we have very strong basis levels, so the cash market's quite strong. And the future spread's still inverted. So that's telling us that the commercial traders want the beans. They're not overly concerned about the size of the South American crop. A lot of fundamental reasons for this market to rally.
All right. Let's look at cotton. We've been following cotton a little bit, on the show for years. We've seen a nice jump these past couple weeks, 250 this week. What's happening in the cotton markets?
Well, the biggest thing that we've got going on in cotton is it has been beaten down so long. I mean, you go back and look at a chart on cotton, and it's just been straight lining for quite some time. We're finally starting to see this uptick. We've got some money coming back into the cotton, and we've got some fundamental interest in cotton as well. Over the years, we just keep reducing the acres, and come this next March prospective plannings report, cotton's supposed to get cut again, possibly down into single digits, so less than 10 million acres. So, we continue to see less area going into cotton, smaller production, and so when the world does start to look for some cotton, prices start to go up. And so we're starting to see some investment money move into the cotton market, looking pretty bullish. It's been a slow grind. I mean, it's slowly starting to work higher, but at least we're seeing the buying coming from both sides, both fundamentals and technical side. So that's a good positive bullish sign for the cotton market to be able to extend this rally.
And I understand that one of the factors that's been keeping a lid on cotton is China's stockpile.
Right.
Has that changed at all? Or?
Yeah, it's come down a little bit, and that was one of the reasons why so many U.S. producers are just kind of throwing in the towel. Not only was corn kind of the golden goose out there and everybody wanted to chase it, but the cotton market was so heavily dominated by Chinese supply and demand situations that it just wasn't really feasible. It just really didn't really pay for to be growing, to be putting that much area into cotton, that much effort into cotton. Maybe that'll change. I've had the opportunity to visit with some cotton producers, some folks from the cotton industry. They think that it will change. After we get past another rough year of acres, another low production year, maybe we start to see some ground coming back towards cotton.
We'll see these prices maybe encouraging people to
very well
move back
could.
into it.
If in many of these areas corn just doesn't work out or soybeans don't work out all that well, because we're going to see more of those going into the south this year. So a couple years of that, maybe they turn back around and head back towards cotton.
Things to keep an eye on. Yeah. Let's look at livestock. We've had two big events affecting live cattle this week. We had the bullish cattle on feed report that came out after market close last week, and then we had the news on earlier this week that Japan was going to be willing to accept older cattle for sale. What does that tell you for the beef industry?
Well, there's a lot of things going on in beef right now in the cattle market, and most of them do look bullish. I mean, before we had that cattle on feed report, we had a very sharp sell-off in the cattle market. I mean, they just plummeted. But that was probably necessary because we had been sitting up at pretty high price levels. Put the market into an oversold situation. We kind of got out of trading the Feb-April spread, and we started focusing more on the April-June spread, which is quite bullish. It is indicating that we've got a much more bullish fundamental situation this spring and summer. So the market's looking at that now. They're taking in all of these month after month of lower placements and just smaller, there's less cattle on feed at this point. So they're targeting that spring-summer summer timeframe. So it looks like we've turned the corner. The cattle market should start going up. It certainly looks like the cash market should stay strong. We're starting to move into more of a seasonal time frame when we start to see beef start to move again. So there's a lot of things, a lot of bullish factors lining up for the cattle market as we look ahead into the spring and summer.
Could you throw a price out there you think we might be able to get to on live?
Yeah, it's just a shot in the dark guessing how far and how fast this market may want to go. Getting back up into the 130s, I've heard some talk of 140s again by this summer. Certainly not out of the question with as tight as the supply situation is.
And you think feeders are going to pull right along with them?
I think feeders are going to try to go along with them because we're just looking at an overall tight situation at this point. Now, one thing that could kind of put a little bit of a damper on the feeder market would be if corn just takes off and runs. But I think both markets are going to be able to rally this spring, so I don't think feeders will be that heavily affected by the corn at this point.
All right. Well, let's look at hogs real quick. Lean hogs, we've been almost in a holding pattern for a little while. Where do you see hogs moving?
The hog market, it's had some bullish fundamentals. It's had some reason to stay this strong. Not only will it not go down, it just really doesn't want to go up very much. It's very cash dependent, and so we need something to really kick the cash market into high gear to get this market moving again. A little bit of a down week this past week, but I do think that hogs, like the cattle, are going to find enough new demand as we go into the spring to kind of start to move us higher. See the cash market move first. That's what's really important in the hogs. Once we see that, I think I think the hogs have a good chance of having a more bullish spring-summer time frame.
All right, so rolling through the summer, you think we'll be good?
I think so. It's odd for me to sit here and say all these markets are going to be bullish, so that means it's probably going to fall apart. But just looking at the signs I like to watch, it certainly seems that way.
All right. Well, thank you so much for being with us, Darin. Really appreciate it. That wraps up this edition of Market to Market. But if you'd like more information from Darin on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll examine the market impact of the Agriculture Department's monthly estimates on supply and demand. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.